Hi everyone, and welcome to our webinar tonight. So we'll be talking about buying your first home. So we're going to go into a lot of details about mapping out the process. If you've never purchased your home before, I want to talk about what that process looks like, going step by step, and also talking about some of the government incentives and programs that are available to you that you should definitely know about, plus some tips. Today, I also have one of our staff members, Alex, who's also going to talk a little bit about the first-time home buyer process and explain that. Alex deals with a lot of our first-time home buyers in our office, and so I wanted him to speak a little bit to how he helps our clients and walks them through that process. So the purpose of the presentation really is to prepare yourself to make what probably is the biggest investment of your life up to this point. A purchase of your own home is not cheap, especially if you're looking in Vancouver. You're making a really big investment, and we want to make sure that that you're making a wise choice and are very well prepared for what you're getting yourself into. So welcome to the presentation. The first thing I want to talk about is why home ownership. And the reason for that is that it's one of the easiest ways to build your wealth. And the reasons for that is that, number one, it's a forced savings account. A lot of people have a habit of saving up money, and usually what they do is, instead of saving first, which is what they're supposed to do, most people spend their money and then save the rest. Those that are good at saving will save first and then spend the rest. However, purchasing a property and moving into it is one of the best ways and easiest ways to actually force yourself to save money, because what you're now doing is you have a monthly payment you have to make every single month, and part of that payment is paying down not just the interest but also the principal on your mortgage. And so I like to call it a forced savings account, especially with interest rates as low as they are today. A very large percentage of that payment is going down directly towards the principal on that mortgage. And so it's a great way of forcing yourself to save up some money. Another thing that is really important here is that your payments build up your equity. And so over time, your home value, especially when you first buy your home, you have a very small amount of equity available in it. But as you pay down that mortgage and as values increase, you slowly start to build up equity in your home. There's a lot of things that you can do with that equity. And if you watch some of our other webinars that we put on, we talk about how to unlock that home equity to invest in real estate or do other things with. But as you pay down that mortgage, you're slowly building up home equity, and hopefully over time you actually can perhaps pay off that mortgage. Not a lot of Canadians actually achieve that, which is kind of surprising, but back in the day, a lot of your parents or parents used to be an objective to make that final payment and pay off that mortgage. And it seems less and less likely for Canadians, especially today's millennials, to actually achieve that dream of paying off their mortgage in its entirety. But if you think about it, when you put less than 20% down, you're typically getting a 25-year amortization, which means that ideally, if you bought your first property when you turn 30, you would have it paid off by the time that you're 55 if you stayed with that schedule. Another thing that's really important here to understand too is that in general, the average home prices usually appreciate. If you look at the average home price in Canada over the last, I think they started tracking this in the mid-50s, you cannot find a 10-year period where the average home price in Canada is not higher over any 10-year period. You go from 1965 to 1975, you can go 1999 to 2009. It doesn't matter. You can't find a 10-year period where the home price has not been higher over 10 years. If you take other markets like Vancouver and Toronto, you'd be hard pressed to find any periods of time where even a 5-year period, the home prices weren't higher after 5 years. Now, that doesn't mean that home prices will always go up. And in fact, in many cases, they're flat for a number of years and then they spike up and go up 20 or 30% within 1 year. But in general, we look at real estate as a nice, safe, secure asset that generally appreciates at a rate of return that we've heard and have seen many times in the past is that it's usually about inflation plus 1%. The target inflation for central banks in many first world countries like Canada would be about 2%, which means that in general, real estate appreciation tends to be, or at least you predict it to be about 3% per year, which is what we usually use for our models when we're predicting the expected appreciation for an investment property or something like that. But even when you're buying your own home, it is also an investment. And so this is something that you do want to consider. you start looking at how much this condo costs today, if you look back 10 years, you'd be a little shocked how much that condo would have cost you if you just purchased it 10 years ago. And you're probably going to be shocked when you see what that value is 10 years from now. Another very cool thing about owning real estate is you can also borrow against the equity. You can borrow against it to invest or do other things with. A lot of people borrow against it to do home improvements, borrow against it to pay off other debts. And in general, because real estate is such a secure asset, it is one of the safest places to park money as a lender. And so that's typically where you get the best interest rates. And this is why refinancing and debt consolidations using your home are such a common tool. It's because a home is one of the best assets for a lender to secure against, which means that if you can get lower interest rates on your home than what you can get by, untypical vehicle loans or unsecured debts, it becomes a hub of your financial stability. Being able to borrow against it to do many different things is a very useful tool. The other thing that's really important here too, and some people have a really good deal on rent, and we have this conversation quite often in our office where a client will say, well, I don't know if I want to buy something. I might get my foot into the door and buy a rental property somewhere else. But what's interesting here is that at some point, you typically do need to move out. At some point, that owner says, hey, you know what, I'm sorry, but I'm selling the property. You got to move out. There's been some situations where tenants have to move 3 times in a period of 12 months, which is crazy. I mean, I can only imagine moving is quite stressful, and imagining having to move 3 times in a 12-month period would seem very stressful. I actually find a lot of the time when their owner decides, hey, I'm selling the property, that's often a trigger for many tenants to then say, you know what, now is maybe the time for us to look in the market. And of course, it's better for you to be prepared in it and working in advance of you being told that you have to move to eventually look at buying a home. But when you own that home, you control where you're going to live. And that's a really valuable thing. And it's not a financial number necessarily that you can put your finger on, but it definitely can be a stress reliever, especially if you've been a tenant and had to move a few times due to circumstances beyond your control. There's a couple of benefits of being a first-time home buyer too that I wanted to get into, and these are effectively government incentives to being a first-time home buyer. The first one is the RSP program. So if you withdraw money out of your RSPs and it goes towards the purchase of your first home, you don't pay any tax on that. And so there's a couple of stipulations. You have to be a first-time home buyer, and to be a first-time home buyer underneath the home buyer plan program, you have to have not owned a home for the last 4 years or longer. So technically, if you bought a home 5 years ago and sold it 5 years ago, which wouldn't make a lot of sense if you only lived in it for a few months, but let's say that you sold a home 5 years ago and you haven't lived in a home that you've owned for the last 5 years, you'd qualify again to use the first-time home buyer eligibility, and you can withdraw up to $35,000 out of your RSPs. You'd have to repay the money back into the RSPs over a 15-year period, and the money has to be sitting there for a 90-day period before you can pull it out. So we just passed tax season, and so if you did make a contribution into the RSPs, if you buy a new home and you're expecting to take the money out of the RSPs for the down payment, you do have to make sure that your closing date on their purchase, and we'll talk about what closing dates are in a little bit. You need to make sure that the money has been sitting there for at least 90 days so you can pull it back out. Another thing that the governments have been doing, and this is an annual thing, and they may or may not continue to do it on an annual basis, but they have been offering up to a $750 credit, a tax credit on your next year's taxes if you purchase a home. And so that's something that the government has been doing. Make sure that you talk to your accountant, or if you're doing your own taxes, make sure you investigate this. Especially if you bought a home, your first home last year, there's a small government incentive to be a first-time home buyer. And the other large incentive here, especially in British Columbia, is there's no property transfer tax on certain price points. And so if you buy a property that's under $500,000 and it's your primary residence and you're moving into it, you do not pay property transfer tax if you're a first-time buyer. If you buy between 500 and 525, then you pay a percentage of the appropriate tax. If you buy over 525, then you're considered rich and you have to pay the full amount of the tax. It's interesting because I've been a broker for 15 years, And this number, when I first started in the business, I can't remember exactly what it was, but it's either $375,000 or $400,000 was the threshold for the property transfer tax. I can tell you that the home prices haven't gone up 20 or 25% since I started in the business. It's probably more like double. And yet the property transfer tax amount has not doubled. So it'd be interesting to see if eventually the government looks at raising it. But as of right now, they call us a starter property or first time property, anything that's $500,000 or less, or you pay a percentage of the amount if you buy between 500 and 525. Now, if you're not convinced if homeownership is right for you, I love spreadsheets. And so I actually made a spreadsheet a number of years ago. You can see that the photo is stretched a little bit. It doesn't look as bad as this when you actually download the spreadsheet, but I did create a rent versus own calculator, and you can do the analysis yourself to see if it makes sense for you to continue to rent or to own your own place. So you can actually punch in what you currently pay in rent. You can punch in what the cost to buy the same property would be. And it'll actually tell you what your future net worth would be if you considered continued to rent versus owning. Now, in most cases, home ownership is more expensive on a monthly basis than renting is, in most cases. However, when you start to consider and factor in the fact that you're paying down a lot of the principal, just that alone, sometimes the net cost of ownership, so the amount you flush down the toilet every month, renting versus owning, in many cases, renting can be more expensive because of the fact that all of that rent just completely gets flushed down the toilet. Whereas when you have a mortgage payment, it's not all of the mortgage payment that gets flushed down the toilet, is the interest cost. Because keep in mind, you're building up your home equity by making those principal payments down in your mortgage. And so by the time you factor in that, as well as certain amounts of appreciation on the home, it's in many cases you need to see a pretty high savings rate in your savings account for you to be better off renting and taking that difference on a monthly basis and putting that into your into investments. When I've done the math before, in general, for most properties, you need to be earning, if let's say there's zero appreciation in the real estate market, which would be fairly unheard of over a long period of time. But let's say there's 0% appreciation, you'd still be needing to make about 9% return on your money in your investments for you to have the same net worth over 10 years. If you assume about a 3% appreciation, then you need to be getting about an 18 or a 19% annual return on your investments for you to be better off renting and saving up more money than you would be to purchase your own home. So in general, the math is quite in your favor to purchase your own property. In many ways, because of the leverage, you can put as little as 5% down to purchase your first home, and that leverage aspect really helps build your wealth. So it's obviously really important to get prepared, and there's lots to do in order to purchase your first home. And so we do want to show you what that process looks like and get to work. You need to get prepared. I don't know why the formatting on this. I swear I changed it to make sure that the D was on the proper spot. Anyways, it's important to start saving. A really good way to figure out how much you can afford is actually to start figuring out what purchase price you'd like to be at, and then look at what those monthly payments would be, and then take the difference between what you pay in rent right now and what those total mortgage payments plus property taxes plus strata fees would cost you on a monthly basis, and make sure you save that difference. So for instance, if your rent right now is $1,200 a month and the total cost of ownership for you would be $1,800 a month, then you should make sure that you start saving $600 extra per month, and make sure you can sustainably maintain that number for a period of time before you decide that you're ready to jump in and purchase your first home. That helps avoid the payment shock of ownership. And I can tell you, when I was a first-time home buyer, back about 15 years ago, I definitely had payment shock. It's a thing, and it's important for you to make sure that you have some savings and you are getting used to having that payment on a monthly basis. Another important thing here is you got to make sure your credit's in good shape. Ideally, you want your credit score to be over 700. Many banks now have a way that you can actually check your credit score online for free, and it doesn't actually hurt your credit rating at all. And so it's really important for you to check your credit and make sure that your credit score is in good standing. If your credit score is not very good, this will make it much more difficult for you to qualify for a mortgage, especially if putting less than 20% down. And the other thing, of course, is getting connected with a good broker like the Green Mortgage team to get a pre-approval. You want to make sure that you're prepared in advance, and the pre-approval will do a couple of things for you. But it's really difficult for you to go out and purchase your first home and start looking with a realtor if you don't know how much you qualify for. And so, getting a pre-approval is one of the first steps to getting your first home. Now, why use a mortgage broker to get that pre-approval? What mortgage brokers do is we shop over 40 different lenders, and our objective is to find you the best rate and best product, and then we're paid by the lender. So we're actually paid by the lenders because instead of the lenders having all of this brick and mortar overhead of having a location, they have all these staffing costs, they have a marketing budget to attract new customers. Instead, with mortgage brokers, all mortgage brokers do is just mortgages. So it's a very efficient model. If you look at the number of transactions and new business that comes into the branch versus the number of those leads that actually close and fund at the branch level, it's a much lower percentage than the percentage of deals that brokers send them that close. And in general, as the mortgage broker, we're kind of the funnel. So we look at things and we figure out, okay, is this a deal that will actually get done at the bank or not? So instead of the bank spending money to process applications that won't fund, in the broker channel, most of the lenders that track our fund, what are called funding ratios, it's usually about 90%. So about 90% of the deals that we send to a bank actually get approved by the bank, whereas at the branch, that number is significantly lower. And so it's just a cheaper model for the banks to bring in new business, and they only pay the broker if the mortgage funds. The other nice thing about using a broker is there's no bias or negotiating. When you're dealing with a mortgage broker, you don't have to go into the bank and this is their rate, and they have to negotiate and see if they can offer you a better interest rate. With us, the lenders don't come out and say, "Hey, you have this rate available, and you get paid this much," or "This rate available and you get paid this much." They just say, "Here's our best rate, take it or leave it." And with that, we can shop the different markets and figure out which lender is going to be the best fit for you. So we're the ones doing the negotiating for you. I will say it used to be that about 15 years ago, you would go into the branch and you'd have to negotiate from the posted rates and get all the way down to this magical mystery discounted rate. And that would be a lot more difficult. And I will say that since the rise of the internet, lenders have become more transparent than they used to be about what their best rates are. But at the same time, too, sometimes you can go into a bank and there's still a negotiating factor that you would have to go through dealing directly with your bank, whereas dealing with a broker, you don't have to get involved in that. One of the things that brokers do is that we specialize in working with mortgages. This is what we do all day long. You don't have to worry about us not knowing what we're doing. Frankly, if a mortgage broker is not good at what they do, they don't usually last in the business for very long. And so usually those people end up becoming employees at a bank or something like that. And a lot of times the good bank employees, if they're really good at selling or really good at mortgages or whatever it is that they're good at, they often prefer to become self-employed and they move over to the broker side. If you're doing a lot of business but just getting paid a salary to do those mortgages, then often they say, maybe I should actually be making commission on this. I'll make more money. And that's where a lot of those good bank reps actually move to the broker side to take off their career. Another nice thing too is that a mortgage broker is here for life. I find that a lot of the time at the bank level, if I finally get a good banker, I'm like, yes, that's awesome. And then they get promoted if they're good, or they get shuffled around, or they have a corporate restructuring. And then the person that I had there is no longer working there and I have to start from scratch again. So mortgage brokers are here and generally are doing the same thing for a long period of time. So there's a bit more longevity there. Another thing about mortgage brokers, we're flexible, mobile, and as I said earlier, with you for life. So that's something that is a bit different than dealing directly with the banks. I think that the flexibility and mobility, the ability to be there for you when you need us, is something that mortgage brokers have historically always been very, very good at. Now, all this being said, buying a home and the dream of buying a home, it seems amazing. Thinking about that and how life will be different if you own your own home sounds great. I'm going to let you know a little secret though. Getting a mortgage is not the most fun thing to do. So those of you that have gone through this process know that it involves a lot of paperwork and a lot of things that are not so fun. But that's why we're here. We try to make this process as easy as possible. And this is where I'd actually like to pull up Alex. He's one of our account managers at Green Mortgage. And And his role is to actually hold people's hands through that process and just guide them through getting the act of getting a mortgage, and making sure that they know what the next step is, and going through that process. And so, Alex, if you wouldn't mind turning on your camera and unmuting yourself, then I'll let you take things from here for a little bit.
It's actually it's not letting me turn on my camera there, Kyle.
Yeah, well then I'll make you the host and it should let you.
Oh, there we go.
Here we go. Here he is.
Hey everybody, my name's Alex. I'm an account manager with Green Mortgage Team, and as Kyle said, I do work with first-time home buyers primarily. Anyways, it's really rewarding for me. I love the fact that I can help you out with your largest purchase in life for a lot of people, and a really good way to grow your net worth. So yeah, it's really rewarding for me, and I enjoy working and helping, as Kyle said, hold the hands of the borrowers or the applicants through the process. So yeah, it's not a super fun process, as Kyle said sometimes, but we just try to make it easy and as easy and seamless as possible for you guys. Not sure how, oh, there we go. So yeah, at Green Mortgage, we do have a lot of processes in place, and part of that is our roadmap here that we send out through each stage of the process and each step. So you can expect really strong communication and essentially just a breakdown of what stage you're in at all times through the process, as well as a breakdown there and a timeline of what to expect and what's coming next. Getting pre-approved. So yeah, once you go through essentially like an intake call, getting to know you, your goals and whatnot, we'll put your file together, collect documents, do the application, and get you a rate held with a lender. Typically lenders allow a rate hold for 90 to 120 days. And as rates are always moving in general, up or down, it's just nice to get something locked in so you can feel comfortable knowing what you're going to be paying. Qualifying for a mortgage. Yeah, so a few key points. So there's credit, as Kyle mentioned. Yeah, you want to make sure you have good credit if the lenders are going to want to lend to you and allow you to get a mortgage there. So a minimum of 620. At that point, we might have to get some lender exceptions, or there might be some limits that lenders allow you as far as getting the mortgage. But typically 680 or higher is where you want to see yourself there. Income. So as far as like debt servicing goes, so lenders will look at about 44% of your total income, total gross income, towards all of your liabilities, including the mortgage payment itself. So keeping that in mind, there is like a quick rule of thumb that we use just to give you some quick math and an estimate anyways, but about 20,000 in income is 100,000 in borrowing power. So it's a 5-to-1 ratio. So that's you can do some quick math there, and that'll give you an idea anyways for a price range that you'd be looking at there. Down payment. So yeah, essentially with down payment, if you're putting under 20% down, then for a first-time home buyer and for a residential purchase anyways, owner occupied purchase, you can put as little as 5% down on the first 500,000 and 10% on the balance. If you're purchasing over $1 million, you're looking at 20% down total. And the property, we just want to check it out, make sure the property's all good, do our due diligence, and essentially look into, if it's a stratified unit, we want to make sure the annual general meeting minutes are good, there's no red flags of the property, upcoming levies and whatnot there. So as I mentioned there, if you're purchasing a residence with under 20% down, then you'd be looking at mortgage insurance. There's a premium involved. So essentially CMHC applies a premium to the mortgage. So it's nice that you don't have to come out of pocket for that, but it is added onto your mortgage amount. And you can see there that if you're 5% down up to 9.99, then you're looking at 4%, and 10 to 15, 3.1, and 15 to 20, 2.8. As far as down payment goes, so standard kind of sources there. You've just got your savings. You've been stashing money away in your savings account, doing a better job than a lot of people. There's RSPs, as Kyle mentioned, as well. You can look to outside support through family and whatnot through a gift. And then as well, if you have other property and you're not a first-time home buyer and you've made a sale, then you can use those proceeds as well towards down payment. And then as well, if you have other property and you have like a home equity line of credit, then you can use that as well for down payment. There are some other non-traditional sources. They're a little bit more tricky and don't always work. So, that's something that if we're going down that path, then just give us a call and we can dig into that with you. As far as closing costs goes, you want to keep these in mind as well. On top of your down payment, they do need to come from your own sources. There's property transfer tax, and as Kyle mentioned there, if you're a first-time home buyer, then you can essentially get away from paying property transfer tax up to $500,000 for a purchase price, and then it scales up to $525,000, and over $525,000, you're a big boss status, so you don't have to pay that. Or sorry, you have to pay the full amount. There are legal fees as well. It's $1,200 to $1,500 typically. And then you have to think about adjustments as well. So for example, if you purchased a property mid-year and the seller has already paid for the property taxes for the full year, then you'd have to essentially pay that remaining amount for the remainder of the year. So there can be some extra costs that are added in there. So writing an offer, once we've got you all pre-approved and whatnot, you go looking at properties. If you're writing an offer, I always recommend that you send us an MLS ahead of time. We can dial everything in for you. Look at the specific property and make sure that you know your qualifications to that specific property, because there's always changing figures as well with strata fees, property taxes, and whatnot. But you write your offer, and then once you get an accepted offer, let us know right away, and we'll start on the financing, look into some options, which we'll already have pretty well laid out for you. But then we can submit the deal to the lender. We'll also be looking into those strata documents, as I mentioned, making sure that the property checks out and there's no red flags from a lender standpoint, like water ingress or anything like that. Inspections. So your realtor will usually be able to help you out with arranging the inspection, but if you do need some help there as well, you can always just let us know. And then removing subjects. So essentially, once we've cleared off conditions, we have an approval with the lender for you, then we'd be looking at removing subjects. So that's a conversation that we'd have at that point. Once we do that, about 24 to 48 hours later, you'd have to have your deposit in, which is typically about up to 5% of the purchase price. And that's in way of bank draft that's held in trust by the realtor for you. Due diligence, as I mentioned there, we're looking into the property for you, taking a look, and we recommend you do it yourself as well. But we want to make sure you're covered off. So we'll look into the annual general meeting minutes and make sure we can see if there's any upcoming levies, any red flags with the building, the depreciation report and whatnot. And then as far as if you're looking at a detached, and you're a first-time home buyer, it's you're doing pretty good. That being said, we want to see a survey, make sure if it's an older building, we'd want to see if the oil tank has been removed, and then as well just see if there's any major work that's been done. We just want to see receipts and warranties and whatnot. Closing. So essentially at this point we've gone through the process with the lender, and now we'll need to set up and you'll be looking to meet with your lawyer or your solicitor, at which point that's where you'll basically be going in for a meeting to do your final document signing with them, and the lawyer will register you on title, and typically I'd recommend you get that set up, as it says here, at least 3 weeks ahead of time, because lawyers are super busy, and that can be something that really just slows up the process and can be a challenge sometimes. So it's always better to just alleviate any pressure that you can and get that set up ahead of time. Insurance. So essentially you'll want to get like contents insurance, and make sure that you're set up there, just because it is, the largest purchase that a lot of us are making in our lives. So it's always nice to be protected. Moving, pretty straightforward. If you're moving, especially in the summertime when a lot of people are moving. If you are hiring movers, I'd be looking into that ahead of time as well, because they can get booked up. And if you're looking to do it on the cheap and lean on your friends a bit, then make sure you order your pizza and maybe get a couple of beers and a U-Haul truck. I just moved actually last week and I did it all myself. I would do it differently next time. And then as far as closing goes, so this is kind of after you've signed at the lawyers, they'll be letting you know that, you know, if you need anything else to complete on the purchase, but at that point, for the most part, you're all checked off, and that's when the keys exchange hands, and now you're a homeowner. So yeah, essentially that's my time here. And if anybody ever has any questions or needs anything at all, I'm happy to help out. And yeah, thanks Kyle for having me on here.
Yep, no problem. No problem. And by the way, everyone, a lot of these slides that we've shown here are actually taken directly from our first-time home buyer kit that's available on our website. So you can download this, and it's going to go through the whole process with you. And one of the slides that we showed a lot earlier that showed the entire process, and it showed 9 little tiles on it. That's actually part of what we call our roadmap. And so as you reach different milestones of the deal, it actually will tell you, hey, you're now at this stage, this is what to expect, and this is how long it typically takes to reach the next stage. And so we try to really make it as easy as possible to help guide you through this process, as it's a lot. It can be stressful for a lot of people. It's the first time, right? So we try to hold your hand. Okay, I want to go through some tips and just a couple of other things. This one is a kind of a neat one. So the RSP money out of nowhere trick. What you can do is, if you put, let's say that you have $10,000 in savings and you're heading to RSP season. So unfortunately, it's a little bit too late to do this season. But if you have money available in savings, you can actually put it into the RSPs and then withdraw them 90 days later when purchasing your first home. So let me give you an example. If your income is at a 30% tax bracket, you could take $10,000, put it into the RSPs, and then when you're ready to buy your home, you're going to pull the $10,000 back out of your RSPs, but you also have received a $3,000 tax refund on your taxes. Because if you're at about a 30% tax bracket and you reduce your taxable income by $10,000, you should get about $3,000 back. So what ends up happening is you turn $10,000 in savings into $3,000 of savings and $10,000 in RSPs, but then use the first-time homebuyer program to take the money back out of the RSPs. And now you have $13,000. So you can imagine, as you have a higher tax bracket and a higher amount in the RSPs, you can actually create a fair bit of cash out of thin air using this little trick. Again, it's really important that you're putting the money into it before the end of the tax season, so at least you get the cash on your tax return now. And also make sure that you don't need the money within the next 90 days because the money does have to be in the RSPs for at least 90 days to qualify under the program. Another thing I want to mention too is that vehicle loans are a killer. This is probably one of the biggest mistakes that we see people make when they're trying to prepare themselves to buy their first home. So earlier, Alex was talking about a little general rule of thumb, about 5 times your income, or the $20,000 in income equals $100,000 in borrowing power on a mortgage. To put in perspective, a vehicle loan is a really big impact on this. And I'll give you an example. If you bought a car for, let's say, $25,000 with a $500 a month payment, that car would have about the same impact on your debt servicing as you borrowing $100,000 in a mortgage, even though you've only borrowed 25 grand on the car loan. And that's because it's all about payments. It's all about the monthly payments. So this is something that's really important to keep in mind. And I've had it before where, we've got young kids, and I will say Alberta is way more guilty than BC of this, but you go out and you buy that F-350 truck or whatever, showing it off to your friends, showing up at the work site, yeah, this is my new truck. It's like, yeah. And the other guy that's driving the Toyota Corolla to work every day and driving that up on the work site, he's the one that has the house that just appreciated 100 grand last year, So it's something to keep in mind, is that if you want to build your wealth, truck loans and whatnot are going to really hold you back. Here's a secret. It's easier to get a vehicle loan than it is to get a mortgage, way easier. So if you really want the truck, buy the property first and then go try and get the truck after, and try and order it in priority. Keep in mind, a vehicle is a depreciating asset. Real estate is typically an appreciating asset. And so ideally, to build wealth, you want to be buying the appreciating assets first and then eventually buy the depreciating assets. If you buy appreciating assets first, there'll be lots of time for you to get that nice truck and show it off of the work site when you can actually afford it. Unsecured debts are also a killer too. To put in perspective, about a $20,000 unsecured credit card, line of credit, anything like that would also have payments that would be equivalent to you borrowing about $100,000 in a mortgage as well. So it's really important to watch out for this. And as you're saving up and getting ready to purchase your first home, you also want to make sure that you're managing your debts and making sure that you're paying off your unsecured debts, because what the lenders use is they use about a 3% of the outstanding balance as a payment. So in this case, if you owed $20,000, they would use a payment of $600 a month, which is actually more than the cost of borrowing $100,000 in a mortgage. And so that's something that you need to be very, very wary of. Most people would assume that, okay, yeah, I can see how credit cards and other debts would be a problem, but they usually don't understand the vehicle loan part. So really wanted to highlight those items because those are the biggest, probably the most common mistakes that we see in the marketplace right now. So ultimately, there's usually a lot of questions that come through this. It's really hard to answer every single possible question that could come up. And so we usually want to make sure that if you have any unanswered questions, book a consultation with Alex or the team, and we can walk you through that and help you understand that process a little bit better. Again, you can download that first time home buyer guide right from our website. We have upcoming webinars. So we have a webinar on the first Wednesday of every month at 7 p.m. The next month's webinar is actually about buying vacation rentals and short-term rentals and how to finance those. It's actually really, really tricky to get financing on those types of properties, but it's become a really common thing that's come up for us in the last little while. So if you have any questions, feel free to reach out. You can download that guide, and we're happy to help. If you have any questions, please feel free to reach out to us, and Alex and I will hang out for a little bit and just answer any questions that you may have. And so, if you do have questions, feel free to pop them into the Q&A, and we'll hang out for a little bit until people's questions have been answered, and then we'll go from there. Okay, so we have a question. Do student loans count as unsecured debts? So yes, they do, except student loans typically have a lower payment attached to them. So unsecured debts usually have a payment of about 3% of the outstanding balance attached to it. Usually student loans have a payment of about 1% of the outstanding balance attached to it, which means that if you had $20,000 in an unsecured line of credit, that would be about a $600 payment. If you had $20,000 owing on a student loan, that would only be a $200 payment. Now, it still is a higher payment than borrowing that money in a mortgage, but it's not as bad as if it was a line of credit or a credit card. And so it does count, but it's not as bad. We have a question from Kathy. Will you be sending out the recording? And yes, anybody that registered for this webinar will be sent a copy of the recording so you can watch it later. You guys are taking it easy on us tonight. Any other questions? Here we go. Lana has a question. So do I need to pay GST if I buy property as a first-time home buyer in a new development? So there are some GST allowances. If you buy a property between $750 and $850, there are some allowances where you might be able to save the property transfer tax, not the GST, on a new home. With regards to GST as a first-time home buyer, it's not actually a first-time home buyer related benefit, and that's why we don't have it in here. But the GST, there is a certain limit, and that's up to $425,000, I believe, is the limit. So if you buy up to $425,000 and GST applies, then you may be able to get a rebate on the GST. If you buy over $425,000, then typically the full GST applies, and it may be $450,000. Between $425,000 and $450,000, I think, is where they start to scale it back. This doesn't come up a lot, actually. New properties for under $425,000, not quite a way of the past, especially for people that live in Vancouver. It's quite difficult to find anything that's brand new now in that price range, but it's now obviously a lot less common. Gabriel has a question. So what is the property tax rebate for a $525,000 property? So if you buy at 525, then there is no rebate. And so if you're at or over 525,000, there's no rebate. Let's say that I'll go over an example though. If you bought at 500,000, there's no transfer tax. And at 525, you pay the full amount, and in between you pay a percentage. Let's say that you buy at 505. You're effectively 20% of the way between 500 and 525,000, which means that you pay 20% of the applicable transfer tax. So to put in perspective, property transfer tax is 1% of the first 200,000 and 2% of the balance. So if you bought something for $525,000, you'd be paying the entire tax, and that would be $8,500 in transfer tax. One cool little program that a lot of our clients use is actually something called Purchase Plus Improvements. And we did a webinar on this last year. But you can actually get the lender to finance improvements to the property for you. So let's say that you find a property for 500,000 that could use a little bit of TLC, maybe some new flooring or new paint. You can actually get the lender to finance, let's say $25,000 of improvements to the property. And once you're done all the work, and you can put it on credit or use cash or whatever, once you're done all the work, then the lender will release the money back to you, and they'll release the $25,000 back to you. So you need to get a quote for the work, and then once you're complete the work, then they reimburse you. The cool thing about this is, especially if you're right around that property transfer tax borderline, you might find that there's two properties you like, one that needs some work but is a bit cheaper and maybe falls right underneath the property transfer tax point where you'd have to pay it, and the other one is already redone but it's over 525. You could find that maybe you could save yourself $8,500 in tax by buying the property that's a little bit cheaper and needs some work. And once the rentals are done, they're both equivalent properties, and you get to choose your own color scheme and your own flooring, et cetera, as well. So we do find first-time home buyers really like that Purchase Plus Improvements program. Yeah, so Surav, there is a government program that assists in the down payment. I'm going to be very frank. I don't know if we've had one client ever actually use it. I think we have one right now that is investigating it. It's very rare that borrowers have been using this program. So, long story short, what the program is the government in BC can assist you with your down payment. And it's called the Home Partnership Program. And what they would do is they could lend you 5% of your down payment, or 2.5% of your down payment. But effectively, they're matching your down payment. The interesting thing here is that that when they first came out with it, there was a lot of restrictions, and it actually made it very difficult for most people to qualify for it, because there were income restrictions, which then did not allow people to borrow and qualify for very expensive homes. So not a lot of people actually could even pull off the program. Those that were interested in it, there was a very interesting point here where for the last few years since the program came out, we've had COVID and we've seen values skyrocket. And the Home Partnership Program effectively says, okay, we're going to lend you some money. So let's say that they're going to match your down payments. So you have 2.5% and the government matches your 2.5%. When you sell that property, they get 2.5% of any of the appreciation that happened over that time period. Now, the interesting part here is to look at it mathematically from a future net worth perspective. Basically, what they're doing is they're trading interest for appreciation. And what's happened over the last couple of years since COVID hit, interest rates have fallen through the floor. And so, rates have been for a long time underneath 2%. And now if you're taking a fixed rate today, it might be closer to around 3%. However, the current appreciation of real estate is definitely over 3% right now. And so, yes, you might be saving a little bit of an interest today, and your payments might be a little bit less today, but then you'll be paying, in my opinion, a lot more when you actually sell the property in a number of years. The other thing too is that the legal fees to register this and the timelines to get this set up are a little bit longer, and the lawyer fees are a little bit more expensive to register this on the title. And so in general, very few clients have even inquired about it. We may find that as interest rates start to shift and interest rates go higher, and maybe if the market starts to slow down, we'll see that this becomes more common. But it's my personal opinion that that condos in particular will continue to appreciate at a pretty decent rate for the next couple of years. And probably more than, and that rate appreciation rate will probably be higher than the interest cost, in my opinion. And of course, that's typically what first-time home buyers are buying into. It's condos or maybe townhomes. So interesting to see what happens. But yes, the program exists, Surav, but very, very rare that people actually utilize the program. Kim has a question. If you have a leased vehicle, what would be the best way to reduce that loan or debt to increase the borrowing power? So effectively, getting the lease out of your name is one option. We've had it occasionally where if you have a lease and we've had parents step in and say, hey, I will now guarantee the lease payments or the loan payments, and that removes their children from the lease payments. And so now the children do not have the obligation, and now they can qualify for a loan. Another thing you can do with a lease is you can actually prepay the remaining payments on the lease, and that eliminates the payment. It doesn't mean that you're obligated to purchase the vehicle once the term of the lease is up. So if you have 2 years left on your lease and your payments are, let's say, $400 a month, you can actually prepay 400 times 24 months. You can prepay $9,600, pay off the remaining lease payments. Now you don't have any lease obligations, and you still have the option when the 2 years comes up to decide if you'd like to buy out the vehicle or if you'd like to hand back the keys. And so that is an option to remove the payment from your qualifications. Bergen has a question. Will buying into a business affect my ability to purchase my first property? Will it affect my borrowing power? Yes and no. So the interesting thing about buying business is that typically business debt is only going to report to your business credit bureau. And so it's not usually going to show up on your personal credit bureau. Typically, however, in many cases, especially if you're starting a startup business, your business may not have any financials and they may require a personal guarantee from you. And so it's really important that if you're getting debt in order to build that business, you need to check and see if that debt is going to be personally guaranteed, and ask the question with the bank or the broker, whoever you're dealing with to get that lending, and whether that's going to report on your personal credit bureau or not. If it does report on your personal credit bureau, then it likely will have a negative impact on your borrowing power, because you as an individual are liable for that payment if it's not made. Now, in general, even if you have business debt that's separate, I do find that in general, if you're business for self or self-employed, you usually are using your own credit to build your business. And this is another reason that in many cases it is harder for self-employed borrowers to qualify. One other thing I need to mention too, we've talked about the liabilities and the debts. We haven't talked about the income. If you become self-employed, the lenders typically treat income, and their method for calculating the income is either minimum guaranteed income or you've averaged for the last 2 years. Now, if you're a salaried employee, this is pretty straightforward because you probably have a minimum guaranteed income, or sometimes if you're on commission or something like that, but you've been working for your employer for a couple of years, or if you get bonuses, we can average the last 2 years in case that number is higher than your base wage. When you're self-employed, however, you don't have a minimum guaranteed income. Even if you pay yourself a salary and you've only been doing that for a year, the government or the bank's not going to say, well, that's a guaranteed income from a third party, because you just made that number up. So they want to see 2 years of track record and 2 years of history of that income coming into your name. And so this is something that can be a challenge. There are some special programs called stated income, where even if you haven't been self-employed for 2 years and filed 2 years of your tax returns, you may qualify. And so those programs are a bit more complicated and very nuanced. Every situation is different, and it really comes down to the broker doing a really good job of selling that. You can put as little as 10% down and qualify under one of these stated income programs, even if you have not been self-employed for 2 years and have the filed income on your tax returns. Last but not least, regarding this, generally when you're self-employed, usually you're trying to reduce your taxable income as much as possible, and that can hold you back from qualifying for a mortgage. So it's really important that you're working with your accountant and your mortgage broker to map out and plan out where you want to be and how much income you need in order to qualify for the mortgage that you want. Then the question here, when you get a pre-approval done by either bank or broker, does it affect your credit score? So in order to be able to look at your situation and understand what your qualifications look like, a credit inquiry is required. So you can't get a pre-approval without having your credit pulled. And so in general, working with a mortgage broker, we pull that once and we shop that one credit bureau to all of the lenders. On occasion, there's a couple of lenders that require their own credit inquiry once it hits their system, but generally we're not spraying it to everyone. We only spray it and send it over to a lender that we think that we want that pre-approval with. And so generally speaking, with using a broker, we're shopping about 40 different lenders, and max you should have about 2 inquiries on your credit bureau. Now that said, if the credits, if the rates are expiring, so Alex was saying earlier that rate holds are good for 90 to 120 days. If the rate hold is expiring, a lot of the time you do need an updated credit pull in order to be pre-approved again and get that rate hold extended. And so it does have some impact on your credit score. However, when you have your credit pulled, it usually is a negative about 1 to 5 points in your credit score. And the credit score goes from about, I haven't seen anybody below 400, but about 400 to 900. So 900 is what we like to call a unicorn, because that's the perfect credit score. If you have a credit score of 800, and Alex mentioned earlier that you're aiming to have a 720 credit score. If you go from 800 down to 755 because you have a credit inquiry, it's not going to pull you from having good credit to having poor credit, and now you don't qualify. We have to be careful is if your credit is right on the border. If you have a 620 credit score, 625 credit score, you need to be a lot more careful about how many credit inquiries you have. And in that case, we usually get our client to actually go and pull their own credit directly from Equifax, send us the report that has a score on it. It might cost you $30, but send us the report with the score on it. We'll take a look at it and we'll assess whether we have an idea of what you can do or not. But it's impossible for us to actually hold an interest rate without us having a credit inquiry in the system. So you have to actually pull it and have it in the system in order to be able to submit it to a lender. Surav asks if there's a new build property price 500 grand plus GST, how do the property taxes get charged? Do they consider the price including GST for tax purposes? So if you're talking asking regarding the property transfer tax, the government does not charge tax on tax, and so they just look at the actual the purchase price before GST is added, and that's the number that they use for the property transfer tax. So no, they would not stack it on top of each other. Unfortunately, if you look at it, it can kind of continue and perpetuate forever if they keep stacking tax on top of tax. And so no, they don't do that. It's just the actual purchase price that they charge the transfer tax on, and then the GST is another cost that gets added. Okay, we had another question in the chat, and Kathy was asking, would you recommend first-time buyers take advantage of the 5% down? And typically, yes. In some cases, if a first-time home buyer has, let's say, 20% down, there is a case to be made to put that 20% down, because instead of getting a maximum 25-year amortization, now it's a 30-year amortization. So your payments are lower because of that. Also, putting extra down payment means that, that your mortgage is smaller, and that means that your payments are again lower because of that. Third reason is that, especially for clients of ours that are maybe purchasing their first home today, but are interested in learning more about real estate investing in the future, and you can also get what's called a home equity line of credit. And if you'd like to learn more about that, we've also done webinars on home equity lines of credit and using that to invest in real estate. But that's a product where as you pay down your mortgage, you're going to have a line of credit limit that slowly increases that then can be used to invest in real estate or invest in other things. You can't do that if you put less than 20% down. Now, on the flip side, the benefit of doing 5% down is that you're getting way better leverage. And so this is something that we teach. And in fact, last month's webinar, we talked about the leverage aspect and why that's one of the most important things about investing in real estate. If you put 5% down, you've effectively leveraged your money 20 times. You've put 1/5 of the property value or 1/20th of the property value down. That means for every 1% of appreciation, your return on investment is 20%, which sounds crazy, but that's the way that the math works. I'll give you an example. If you bought a property for $500,000, if you put $25,000 down for your down payment, if the property value just went up by 1%, so it goes up from 500 to 505, you've made $5,000 on your $25,000 investment. So if you make $5,000 in $25,000 investment, you've made 20% return. So the property value went up by 1%, but your return on your investment is actually 20%. And so, we believe that in general, depending on the situation, if you have the ability to either put 5% down or 20% down, we usually recommend one of the two opposite ends of the spectrum. We don't usually recommend 10 or 15% down. Yes, the CMHC premiums get a little bit smaller, but in general, if you have ambitions and plans to buy more real estate down the road, it usually makes sense to just do either 5% down, and then you have more cash to do another purchase of another residence for yourself later on, which, by the way, you don't need to be a first-time home buyer to buy with 5% down. You just need to be purchasing your own residence, which is a really important key. And you'll have more cash available for that. Or the other option is you put 20% down, and then maybe you pay down your mortgage and then use your line of credit to use to fund a purchase in the future. So it's a question, Kathy, that kind of depends on the situation and circumstances and the preferences of the borrower. But we often do say if it's do something with 5% down or don't do anything at all, then we recommend absolutely get your foot in the door. This, Canadian real estate is a very strong and very safe place to park money, and we expect that that real estate appreciation will be strong for at this point in time and definitely moving forward too. Tri has a question. Do I lose any first-time homebuyer incentives if I was on title for another family member's home? It was not my primary residence. So we're actually looking into this just today. And we had a situation that was kind of similar to this. So the way that it's worded is that if you're not on title of a property that you were occupying, and so I believe, and we would usually pull up the exact verbiage. And if you send us an email, we can pull up the exact verbiage on the government website to look into this. But I believe that based on that situation, that you would still qualify as a first-time home buyer under the home buyer plan, so the RSP plan. However, if you're on title, you would still have the property transfer tax costs that you'd have to pay. No matter what, if you've ever been on title, then technically you're not first-time home buyer when it comes to the eyes of the government for the property transfer tax, but you may re-qualify for the home buyer plan to be able to pull out up to $35,000 out of the RSPs. Awesome. Any other questions, guys, before we head out? Oh, got one in here. Awesome. AJ, how would your advice differ between people trying to buy property and continue buying and selling properties versus people just trying to buy a single place to live? Okay, so I think your question is, buying properties, and I'm not sure if you intend or mean that these people might be flipping the homes and continuing to buy and sell homes versus just buying a single place. I guess there's two ways of looking at this. On one hand, one of them is very simple. Buying your own residence and just living in it is very simple. And it's probably a little bit different than buying and selling over and over and over again. Keep in mind that every entry and exit point out of real estate is going to cost you. You're going to pay property transfer tax every time you buy something. You're going to be paying a realtor to sell the property every time you sell it, and so that those transaction costs can be a fair bit of money. To make this a bit easier, if I remove the fact that you're buying a personal residence, and let's just say that you want to either flip homes, so you're buying and selling over and over again, versus just buying a rental property, something you're going to just hold for a period of time, because I think it gets a bit more muddy too. If you're buying a property that you're going to live in, but you keep buying and selling over and over again, keep in mind you're also moving all the time. And Alex will tell you, moving is not fun, especially if you don't hire movers and you don't get beer and pizza and get a whole bunch of your friends to help you. So if you're comparing those two, it's actually very different businesses. One of them is very active business. Flipping homes is a lot of work. Dealing with contractors is a nightmare. For any of you that have to deal with contractors, it's really difficult to get those done. The benefit of doing flips is you can create cash injections of cash for yourself fairly quickly, especially if you do it well. But it is a very different business. It's a very active business, whereas just purchasing a home and just living in it is a very simple way of doing it, or just buying a home for a renter to live in is a very simple way of making an income too. So, we've had a lot of chats with different investors, and Sometimes when you're new and you don't have a lot of wealth yet, you're more inclined to work for that wealth and do some flips and generate that cash. But most of the wealthy people are not flippers. Most of the wealthy people are buy and hold type of people, if that helps answer your question, AJ. Awesome. Well, thanks so much for attending our seminar tonight. We hope that you got a lot of valuable information. Alex, maybe if you just want to jot your contact info into the chat there, and then if anyone has any questions,
sure.
yeah. Thanks, Anne. Good to see you. There you go. Yeah, if any questions come up, feel free to reach out to Alex, and we're here to help. So thanks so much, guys. Looking forward to helping you buy your first home.
Thanks, guys.